I'm Dan Gross from Newsweek and Slate.
And I'm Jim Pethokoukis from U.S. News and World Report magazine.
Jim, good to see you. Even though I can't really see you, I'm going to act like I can see you.
Yeah, right. I mean, we're just looking into the black void, or the black lens. That shows that we're pros, that we can do this, yet somehow appear actually be seeing each other. So I think that's a great compliment for us.
Indeed. So lots to discuss, as probably too much to discuss, as per usual.
Right.
This has been the case for basically the last year, ever since Bear went down.
I'm going to say right now that I did not prepare for this, so maybe we should just open it up for questions. We'll take questions right now.
To the audience?
Yeah, we'll go.
Absolutely, yeah.
We'll just. I guess we can actually do that.
So,
joke.
Have you been following this thing with Goldman Sachs? I think the first, one of the questions I have is Goldman Sachs simply, evil, or are they just smarter and better than anyone else? The latest thing has to do with the fact that they're harassing this blogger who has started. It's a blog or website that sounds like Goldman Sachs is evil at Blogspot or whatever,
right.
And they're sending him cease and desist letters. Have you followed that?
Yeah, a little bit. Wasn't there like a 666 or something?
The sign of the mark of the beast.
Very subtle. One thing I think it says that this bold new future of journalism that we're supposed to be entering, where it's going to be bloggers, doing all this reporting. I think you're going to find out that bloggers will be very easily intimidated. For the most part, by a cease and desist letter from a corporate attorney.
They will or will not?
I think they will. I think in general they will be now. As far as Goldman Sachs being evil, they're just being a cold, calculating corporation. They are neither good nor evil. They're transcendent. They're a fictitious person. But this bothers you a lot, Dan?
The demonization of Goldman Sachs?
Does that bother you? Do you think
No, that doesn't bother me, because
right.
I'm willing to say, Bear Stearns is the sign of the beast.
Right.
But, no, I do go back and forth on Goldman Sachs. Dial back. Henry Paulson was the CEO. When they lobbied the SEC and got permission to leverage up the investment banks, which, of course, caused was the seed of their demise. Then as Treasury Secretary, he and an assistant, Neil Kashkari, who oversees the TARP, dispense the money. They decide to save AIG. Guess who one of AIG's biggest counterparties is? Why, it's Goldman Sachs. And then you roll it out down the road as how this bailout has gone. They took $10 billion in TARP money. They said they didn't need it. Fine. Everybody took TARP money. They're loudly saying they're going to pay it back sooner rather than later. Okay, I'll believe it when I see it. But they've also been, the biggest issuer of the FDIC guaranteed debt, which is a subsidy of many hundreds of millions of dollars a year. And I was talking to someone over the weekend who said, on top of that, of course, they are. All that debt, that FDIC-backed bonds, gets underwritten. There are underwriting fees associated with that, and they're very big in that too. So, are they simply
it is an ill wind that doesn't blow somebody some good, and they are clearly it is clearly going to be benefiting them. Now, listen, for demons, I mean, these guys they don't have access to some special underworld power here. I mean, they were certainly they didn't see this downturn any better than anybody else did. I mean, my gosh, I remember looking at economic reports from these guys talking about the 5-year boom, and everything looked great. So they were certainly suckered. But I suppose it's a sign of some sort of genius that you were able to adjust on the fly, like a football team. What was it? What was the coach for the 49ers, Bill Walsh? He used to outline the first 20 plays.
Right.
Well, then after that, you sort of have to think on your feet. Obviously, Goldman Sachs has been very adept at taking advantage of sort of the new lay of the land. I mean, I'm not sure how much this necessarily bothers me, though.
Right. Well, I guess the question is, to what degree are they simply taking, these programs are made available, they are running, to the bank with them, or there is something more calculating in that these programs were designed specifically, by former Goldman Sachs people, with the advice of Goldman Sachs people, with former Goldman Sachs people in the White House and everywhere in the bureaucracy looking on, with the expressed intention of benefiting the firm.
Well, I'm not sure I would entirely rule that out. I mean, I think it's really more of a matter that I think they have a particular worldview about the way things should work, and that's certainly informed by their years of service working at a major investment bank and financial institution. So that's going to, like I said, that's going to inform the kinds of decisions and the kinds of programs, they're going to come up with. But Hank Paulson, it's hard to see, rhyme or reason or a huge detailed plan for what happened to the Treasury Department in the fall of 2008, where they had Plan A. Then they had Plan B, and then it kind of looked like they were going back to Plan C. So if there's a master plan here, someone should tell them, because I'm not sure.
In order to believe that Henry Paulson was an evil genius, you'd first have to believe that he's a genius.
No, and I'm not saying he's an imbecile, but when you come up with a plan, you scare the hell out of Nancy Pelosi and just about everybody else in Congress, saying that we're going to be going back to the Stone Age. We'll be driving cars with our feet like the Flintstones if we don't pass this $700 billion bailout, and they say, whoops, actually we need to do something different with the money.
Right.
That tends to undercut your reputation as a mad genius.
And that was one of the best moments, some of the reporting that came out that Paulson kind of got down on his knees and was begging Nancy Pelosi. If we had
right.
The fact that someone did not snap a cell phone image, that would have been much better than the Michael Phelps doing bong hits.
Right. It was like a Ghostbuster moment, Bill. It's like going to the mayor and Ghostbusters. It's going to be cats and dogs living together, wrath of God stuff. And apparently they found that persuasive. To this day, there's congressmen who sort of get a little glassy-eyed when they remember that moment, talking about the various scare stories. But I think it's kind of getting worse and worse and scarier in the telling. So to speak. But yes, Goldman Sachs seems to be benefiting, and they are certainly landing on their feet.
So something else stemming from Goldman Sachs that...
Am I allowed to drink a beverage on this thing?
You can drink whatever you want.
I'm going to have I'm going to try to hold it so you can't see what I'm doing.
You guys still have beverages at U.S. News?
Oh, my gosh.
We're reduced to water.
We have hot and cold running water in the bathroom still. It's, it's fantastic. We're doing great.
We're down to cold here. So, one of the issues was that, a lot of the money that went to AIG was used to either post collateral to counterparties or to make good on credit default swaps. And, there were several billion that went to Goldman. Right. And then Goldman's CFO had a conference call with reporters to kind of stem some of the outrage, saying, look, yes, they paid us that money, but, we were sort of hedged against this. This was a bailout for us. This was not a bailout for us because we had hedged against this, and we weren't really worrying about that money so much. And I was at a conference at George Washington a couple of weekends ago, and a guy who's a professor at the University of Texas named Henry Hu, H-U, gave an interesting talk about what he called empty creditor syndrome. And what he means by that is when in a normal situation, when Jim, you lend me money, you're my creditor, I owe the money to you, and if I fail to pay, the consequences to you are fairly obvious, and so you'll be really worried about that. But in this new world where you could then go out and hedge your risk and buy credit default swaps, it's as if that $1 million you've lent me isn't really $1 million liability to you because you've insured against it, and so that your behavior, if I start to go bad on my debt, might not be what you would expect from a typical creditor in that situation. The Washington Post had an interesting article that touched on the same topic today. In their business coverage, it was about Six Flags, the big amusement park company that has Dan Snyder, who owns the Redskins, owns it, and they have a horrible capital structure. They're hundreds of millions of dollars in debt. They're basically saying they're trying to engineer a debt for equity swap outside of bankruptcy. But there's one bondholder, and they think it's Fidelity Investments, that owns about $100 million of these bonds, and it won't come to the table. All the others have sort of agreed. And one of the theories in the article was that they actually want the company to file for Chapter 11 and formally default on the debt because they had bought credit default swaps against it. So they're refusing to participate in this, what would seem to be the rational thing to do because they are an empty creditor. And I guess the question is, has the,
It's the new rationality. We have the old rationality, but we have these complex, somewhat complex financial instruments, which are sort of jumbling, behaviors, relationships, risk-reward ratios, who's taking the risk versus what their reward is. And I tell you, I was somewhat mildly surprised that in all this financial reform that the White House wants to do, that they didn't take really a much tougher line on these credit default swaps. At the very least, trying to limit these credit default swaps to people who actually have a little skin in the game, people who are actually involved, not people who are just speculating on whether someone's going to go bust. But no, they're actually going to keep those, and I found that a lot of people are concerned that a lot of especially people on the left are concerned that this administration is still too centrist, and and I know people I talked to that was one thing they pointed out, that this they're very worried. Larry Summers is the Clinton administration, former Clinton Treasury Secretary, and that they have not taken a much tougher line on these instruments.
Well, so what is the proposal with, because I was a little distracted last week, what is the proposal on the table with credit defaults? They just want a central clearinghouse? Yeah, I think it's really just a central clearinghouse. Want to make sure that, keep an eye on these things, but don't necessarily want to limit them. You also have a similar situation with hedge funds, because they want to, have far more hedge fund registration. And it's, in a way, let's take the case of hedge funds. It's very difficult, I think, to make the case, that they shouldn't be registered if the whole theory before was that you had these very sophisticated investors who could keep a good eye on the hedge funds, and they knew where their money was. And of course, with the Bernie Madoff scandal, people who had money, people who were supposed to be very sophisticated investors, and they still found themselves being taken to the cleaners. And now, obviously, since the Madoff scandal, you've seen a few more of these sort of Ponzi schemes, all of which were made seem to be made good when the market's going up, but not so much now. The better rationale for forcing hedge funds to register is not for the protection of their fat cat investors and the institutions like endowment funds that invest in them. I think it's more for the system. In other words, by forcing them to register and provide more disclosure about what they have going on, then we won't be as surprised when it turns out somebody's been writing insurance on, $500 billion in corporate debt and has no ability or willingness to make good on those payments, which then has, systemic implications. I mean, that's basically what happened with
AIG. And certainly we have a situation where we're not going to let these institutions that are so-called too big to fail. We're not going to take the, the 1920s Andrew Mellon liquidationist school, where we're just going to let things fail and see where the cards land. Obviously, if we're going to do something, then we should know, what the potential risks are going to be.
So here's what I don't get about the credit default swaps issue. It seems like if these were traded on exchanges, the Chicago Board of Trade, Chicago Mercantile Exchange, one of those derivatives markets, and there are a ton of derivatives markets and exchanges around the world for whom this would be really good business. Because they're always looking for new things. And of course, to protect themselves and the players in their markets, all those markets require people, if you are trading grain futures or gold or whatever the thing is, you can't just say, I'm taking a position of, $100 million in cotton futures without putting any cash up. You have to put a certain amount of cash up, and that prohibits any one person or institution from taking positions that are too big. Why are not the exchanges either banding together or the big ones coming together and saying, let's put credit default swaps on our platforms, this is a new line of business for us, and basically we will enforce the type of requirements that would have prevented AIG from happening.
I very much like your more free market approach to regulating these credit default swaps rather than a regulatory reign of terror. I didn't really expect to hear this, Dan. That doesn't sound like the worst idea in the world to me. So maybe we should move beyond credit default swaps. Is anybody still watching this? After 10 minutes on credit default swaps, is anybody?
Credit default swaps are hot.
I know they're very hot for at least people in the 212, maybe 202 area codes. For the rest of the country, they've probably been credit default swapped out.
All right, give me something more populous.
Yes. We want to move on. All right.
Yeah.
One thing you had mentioned in email, maybe we wanted to talk about was the economy. Some green shoots popping up, perhaps, or mustard seeds, whatever you're going to call them.
What is the deal with I know Bernanke said green shoots.
I find that very European. I'm very suspicious of that. That does not. Do people talk about shoots That's like on the news when I refer to the Pope as the pontiff. People really don't talk like that in real life. People actually call them shoots.
But the amazing thing is that CNBC is kind of in its a desperate effort to latch onto anything positive. You could, if I had the capability to compile video clips, I would have Bernanke saying green shoots, and then like a gazillion things in a row of people on CNBC saying green shoots, green shoots, green shoots, green shoots, green shoots. That's the new mantra. But I can see. I'm not a gardener, but I see the relevance of green shoots. What is the mustard seed?
Well,
what does that mean?
Mustard seeds and you get like a mustard plant. So that's it's kind of biblical. It's kind of biblical. It shows it shows birth and blossoming and.
Yeah, but is there a reference to mustard
there
seed
is
in the Bible?
It is there is a parable of the mustard seed by our dear Lord Jesus Christ. So I think okay. So maybe it depends how secular you are, whether you want to use mustard seeds or green shoots. I don't know. I hate
my reading of the Bible stops before that. So eye for an eye, tooth for a tooth, anything like that.
Right,
stone tablets.
Right. But green shoots or whatever you prefer.
So, but what is the parable of the mustard?
The mustard plant, its growth. I was not prepared. You got me. I was not prepared for my parables at this moment, despite the fact we just had Easter. But there are some green shoots. There are you have to look hard, I think, to find some of them. You can look at prices of commodities, which have stabilized or in some case really risen, like copper and oil's bounced up, which has really led some people to conclude. And trust me, there was certainly a point over the last 6 months where we're talk. I don't know if you want to call it a Great Depression of something that is overly reminiscent of a depression people were talking about. I think I'm not sure people are quite so worried. I know that the people like Nouriel Roubini are still quite bearish, but I'm not sure that as much as you can take anything off the table, I don't think that's a concern. What do you think?
Well, I think there's also when people talk about the green shoots and the recovery, we have to the rate of fall has to decelerate before we can turn around. And I think if I'm seeing green shoots, it's that. It's not that the worst is behind us.
The momentum is
the
slowed.
Worst of the very sharp falls. I don't think we're going to have too many more months of 600,000 and 700,000 job loss. I don't think we're going to have another quarter of negative 6% growth. We work things through pretty quickly. In the real economy, housing and finance is another area that's going to take longer to clean out, and the stimulus is coming. So, but I think if people are, there's some, I don't think sort of confusion about, could we have growth in the second quarter, positive GDP? Maybe. Are we going to have employment growth anytime soon?
That is a disconnect, because they've seen the market bounce back fairly strongly. They may start seeing, hearing reports about the economy actually expanding. I don't know if it's going to be the second quarter, third quarter, but they're going to hear about the market, and they're going to hear about GDP growth, and yet they're also going to see the unemployment rate continue to rise. I think that's really going to be the big story for the rest of the year in 2010. Is that even though we may have a mildly expanding economy, that we're going to have probably a fairly still dramatic rise in the unemployment rate. Now, how high? 10%. If you look at these past sort of economic crises, where we've also had a banking crisis,
right.
And you've seen some very sharp unemployment. Harvard economist Ken Rogoff, he's come out. I think he has a book coming out or something, and he thinks unemployment's going to get up to 13%.
Right,
and that's an awfully high unemployment. Remember, during the 80s, during the 81, 82 recession, unemployment got up to just a hair. I think it was 10.8%. And trust me, I'm old enough to remember that fairly clearly. And it seemed like everybody was unemployed back then. And 2 percentage points higher than that, it is going to feel horrible. And of course, if you add in people who are, the various wider metrics of unemployment that look at people who've sort of just given up on unemployment, actually could reach, by those measures, closer to 20%. So it is going to feel horrifically bad, even though we actually may have an expanding economy.
So yeah, Rogoff and Reinhardt, Ken Rogoff and Carmen Reinhardt. That's the name check on. They had the definitive paper about what happens in economies after recessions that are brought on by financial crises, and it's generally nothing good happens.
No, it's absolutely horrific.
I'm not sure where that paper is, but if you're watching out there, Google Rogoff and Reinhardt.
Right. And
little R&R.
Right. I mean, whether you and if you look at, and there are other papers too by the IMF and the World Bank and so forth. They've looked at both, everything from Japan to problems in Scandinavia and to the emerging markets, and it really doesn't sort of matter whether you're talking about an emerging market or developed country. When you have these kinds of situations, it takes a while for the economies to recover. So that's why you're looking at. I think people are going to. If there's a year from now, people are probably going to think this economy is still miserable. Now I'm not sure if how that's going to affect.
Here's something I want your opinion on, because you like me are not an economist by training, and you, like me, spend a lot of time consuming economic research and talking to people. One of the great mystifications is the way the economists and the profession, as a group, fails to predict turning points in the economy. In other words, right when we're about to go into a recession, they're predicting 1 or 2 or 3% growth, and right when we're about to turn out of it, they're predicting negative 5% growth. And in the case of this most recent one, where we obviously slowed and then had a couple quarters probably of negative 6% growth, the failure to be even in the ballpark can have catastrophic results for companies. And so the question is why. I understand that it's very difficult. I wouldn't want to be in this position. But why do they get it so wrong at inflection points?
Well, I mean, I suppose you can, you could point to two things. One, just sort of how we're hardwired psychologically. As you know, there's this huge field called behavioral economics, behavioral finance, which kind of looks at how people make decisions, especially how they make economic and financial decisions. And we have all kinds of quirks that make us kind of think tomorrow is just going to be like today. For instance, there's something called anchoring, which once you sort of make a prediction, you're going to kind of stick to that prediction no matter sort of what happens.
Right, but Jim, these are the people who know all about these things.
They are aware of these own foibles.
It's like a doctor who refuses to vaccinate himself.
They are doctors who smoke. I mean, you know the problems. So I think there's that theory, and then there's more the sort of the black swan approach, and that life is made up of unpredictable events that are by their nature unpredictable. So there's no way you can catch these inflection points. If you happen to catch an inflection point, it's because the stop clock is right twice a day.
Right,
so don't expect people like Rubini and Meredith Whitney and the two other people to predict this. Don't ask them what's going to happen.
Exactly.
The odds of them catching the turn up, like they caught the turn down, is really highly unlikely.
We all remember Elaine Garzarelli, who called the crash of '87 and then called nothing since then.
That's right.
But
what's your theory? What's your theory?
I don't know. I
didn't realize I could say I don't know. I would have said I don't know.
I think part of it is the way the people at the Economic Cycles Research Institute, where this is all they do, and they have a line about how people they extrapolate, they forecast by analogy. They extrapolate from the last few months or the last few years, and then take that into the future. And then they also say, well, this kind of looks like another period. Therefore, this is what this coming period will look like. It's amazing to me they don't take into account the way. I mean, if you want to compare 01 to 93 or whatever, you have obviously historical information, but with every year, the shape, the geography of the economy changes. Right. And the pace has been so rapid that it really renders comparisons kind of worthless. I mean, think about the economy today versus just 20 years ago, which isn't that much distance in history. The emergence of China, the volume of trade, the way who's accounting for what percentage of GDP. In place like in 2006, there were 100 countries growing at over 5% a year. That had never been done before. But the cumulative impact of that was to make the global economy look like a very different creature in '07 than it was even in 2002. And so you would expect that that having these historical comparisons isn't particularly useful. And in the case of ours, I mean, if we look back on what happened in our economy from, in this decade, which, by the way, is the subject of my book, Dumb Money, It was actually out in paperback today. Thanks for mentioning that, Jim.
Excellent.
Appreciate the plug. You could have seen the dependence of our economy on housing and real estate finance. It was all out there. We knew, the economists were telling us, that a very large percentage of jobs and job growth had been created by housing and real estate. Greenspan did those papers on mortgage equity withdrawal and how much, the fact that people could refinance and rising home values was supporting consumer spending to a very high degree. So we had this picture of the economy as being really dependent and heavily influenced by housing and housing-related finance. And housing prices started to fall in 2006 and fell pretty much every month. So by the end of 2007, when the recession started and when economists were saying we're going to have 3% growth, the thing that had been driving the economy and accounting for this hugely disproportionate job creation and support of consumer spending, because incomes weren't rising, had been falling for more than a year. So it's still a mystery to me why they couldn't draw the dots.
Well, now listen, if you've read the movie The Black Swan, you're making the classic mistake in which you're taking all these events in the past, you're linking them together and saying, how did we miss it? It's so logical. A cause B cause. It's an obvious daisy chain of events. If it was that obvious that the 300 economists for the Fed would have called it perfectly, you wouldn't have had Bernanke up there saying this was a $100 problem.
That's right. There was plenty of people were writing about this, and the relationship between the two.
Well, it's all about the time. It's time. You can say that at some point this is going to cause a problem. Okay, you say it's going to cause a problem, so you have to get the timing right and you have to get the magnitude right. I mean that makes it immensely more difficult to do either of those things. I mean, being really early is a lot like being wrong, and even Rubini. Who has become? I imagine he's become a millionaire based on this call. He didn't get it completely right. He was talking about the dollar collapsing, and that was going to force interest rates up higher. So to some degree, here's a guy who was right for the wrong reason, but yet sort of in the misty past, we think he just got it right, and this guy's a genius.
No, look, getting the magnitude of this crisis wrong, I think, is utterly forgivable, because the range of things, the failure of Bear Stearns, Lehman Brothers, AIG, Fannie, Freddie, the systemic issues, again, that I think is utterly forgivable. To stand there at the beginning of 2008 and the first and second quarter of 2008 and saying, oh no, we're not having a recession, that jobs had been falling for many months, housing was going down, the subprime lenders had already failed, and the evidence in the bad lending practices that people like to wall off in the subprime area were happening with private equity leveraged buyouts in the corporate world. It was all out there. I just think there was a failure of people to connect the dots.
Well, but then of course, at the end of 2008, you got a whole bunch of brand new dots, which is you had a panic in the credit markets. You can blame. Some people want to blame Lehman Brothers for not saving Lehman Brothers. You want to blame the TARP plan for being the wrong plan, or even the mere existence of it sent people into a panic. Oh no, we got to spend $700 billion. So was all that foreseeable? If you could foresee all that, then you could say, wow, not only is this going to be we've gone from a 2001 style sort of mini recession into something that may be the worst since the Great Depression. So the bottom line, very hard to predict. It is very hard to predict.
So what else you got?
What else I got? We have the green shoots. We have what about our pal Tim Geithner? He looked like the Wonder Boy. Then he sort of looked like a Peter Principle sort of personified. That he couldn't handle this job after rising through the ranks. He seemed to know everybody there was to know, and now he seems now they think the plan is at least halfway decent. His new bailout plan. What do you think of Geithner?
I think, you're familiar with the Filer Faster thesis. It's something we popularized on Slate. Bruce Filer, who, he was Walking the Bible and those books, said that, in the age of the Internet, the media kind of churns through the normal processes in sort of spitting stories out much faster, right, 24/7. Now, of course, that's accelerated with cable news, et cetera. And so I think the normal arc of someone's kind of career from saying, oh, he's great, oh, he sucks, oh, he's somewhere in between, which, I think for most people it takes a couple of years for that to play out. Now, that all happens sort of within a week.
Well, it's going to happen within a week, especially if you're in a position that's going to be judged by, in real time by the financial markets. I mean, the financial markets aren't judging, what effort by, Gates at the Defense Department, what he's doing. They're not judging, the head of the Labor Department, how their job. But when you're the Secretary of the Treasury, the markets are going to, turn, especially in this environment, they're going to turn on every word, and you're going to get an immediate. You're going to get immediate feedback whether they think you're doing a good job or a bad job. And if the market goes down, the assumption is you're doing a bad job.
Right, but the market, when I hear people say that, the markets on any given day, they don't know what the hell is going on. And I think, one of the things we should be disabused of by the actions of the past year are the efficient market hypothesis, the rational actor hypothesis.
Markets are pretty efficient.
They're efficient.
Actors are pretty rational, not 100% rational.
In other words, everything that modern economics is based on, they are efficient in the long term. They are relatively rational in the long term, but in the short term, they're a bunch of freaking lunatics. And if you can find me, I did a book about bubbles a couple years ago, and somebody...
That is on my bookshelf next to our family Bible, a book on
well,
bubbles. That is a great book. Really, don't buy this new book of his. It's probably not good. But the last Pop was excellent.
There's the parable of mustard seed in there, too.
Yes.
So, but someone who reviewed it said, well, economics is about the science of efficient allocation of resources. And I was like, where have you been the last 20 years? Because if you lived through the dot-com bubble, and if you were just in New York in general, this economy has been about kind of massively inefficient allocation of resources on a systemic basis, first to technology and dot-com stocks, and then into housing, and we've seen it throughout the years. And of course, in some instances, it ends up providing net positive. So in the long term, it made sense to do that. But to me, the examples of the refutations of the hypotheses about markets are efficient, people are rational, you can depend on the agents of the firm to act in a certain way because they're accountable to the board and their shareholders. I mean, none of that theory accounts for anything we've seen in the last 5 or 6 years.
Right. There's a great scene in the film Awakenings. It's a Robin Williams film. You have all these people who are basically in comas, and the assumption is that they're in comas and they have no perception of time or what's going around them. And so one doctor says to the other, well, they're in comas. How do you know they have no perception of the passage of time? And the answer is, well, because the alternative is too horrible to imagine. Well, so your condemnation of markets and rational actor theory. Sort of what is the alternative? I'm not sure there is a good alternative.
Well, you have a range of actors, some of whom are rational, and some who are.
Would you prefer because the alternative, of course, the free market would be more government actors and the same sort of behavioral quirks and lack of rationality. That also affects the government actors.
No, I don't think we don't substitute one for the other, but I think you have a recognition that. This is the same thing in international relations. This is why I preferred history to political science, because history always had the rational actor theory of international relations, and every crisis they went through said, okay, this is how rational. We had Nixon, you had Hitler. These were not rational actors. In other words, to try to shoehorn what people do on the basis of what a rational person would do does not account for the fact that people get into positions of power who are frequently neurotic and crazy.
Well, you've just described probably, I think, 6 billion people maybe on the planet Earth as far as being neurotic and crazy. But it's this reason, it's this exact reason why if there's one thing I want, which is I generally want economies to grow very fast. I like economies to grow as fast as possible, so there is a nice cushion inside your economy for bad decision making. So that's what worries me, is when we try to focus the government on things beyond creating economies which are very prosperous, which creates a lot of economic growth. We start saying, growth is good, but we need to do these other things, that's when I worry, because I'm worried that while we're doing these other things, we're going to have a much slower economy, and then when something goes wrong, instead of having a period of somewhat less economic growth, we'll have a recession, or perhaps a very sharp recession.
True, but there's more to life than speed, right? There's
you give me 5% GDP growth, I'll take my chances with the rest. I mean, don't you think?
Well, I guess
it
depends how that growth is distributed and how that growth is fueled. If it's distributed in such a way that median incomes don't rise, which is what we had in this past business cycle.
The economy didn't grow fast enough the past business cycle.
So it was the
lack of economic growth.
Listen, if we had more leverage, middle class people would have gotten rich.
Well, you can say where you want this economic growth to come from, but if the economy had been growing at a 4%, at 5%, which I don't think is necessarily out of the question, you could argue about that. I don't think we have time. I'm not going to worry so much. I think everyone's going to get rich. Everyone's going to make a lot more money. I'm not going to be worried so much about the distribution of wealth. I mean, that was the case in the late 90s. We had a very fast-growing economy, and people quit worrying about the distribution of wealth.
But it wasn't at 5%.
No, it wasn't an average of 5%. But you had a lot more what I like to call hyper-growth quarters, which are quarters over 3.5%. You had a lot more of those kinds of quarters then than you did. I think in the past 10 years, I wish I had the numbers in front of me, but you had very few quarters over 3.5%. I mean, it was a nice economy, but it wasn't a rip-roaring economy, which then people start focusing on things like inequality of income and that kind of thing.
Okay.
Pedal to the metal. That's my philosophy. Grow as fast as possible. What do you got now? You got anything? Anything left there?
Well, let's close with a cheering, happy example, GM. I can tell from your accent that you're a Midwesterner like me.
Where are you from?
Michigan.
Oh, okay. All right. Yeah, I'm from Chicago.
Yeah. Grew up playing Little League one of the fields we played on was literally in the shadow of the Fisher body plant, which is no longer. And so I regard, the GM situation, which I think is much different than the Chrysler and Ford situation, with a mixture of horror, because I see what it's doing to the economy of the state in which I grew up is really suffering badly, and for where I grew up was East Lansing, which is a college town, the state capital, basically fine. The Detroit area and many other parts of the state, big problems, and yet a sense that I actually kind of like what the auto task force is doing, getting tough with the management, getting tough with the bondholders. They're probably going to have to get tough with the unions, and so I'm not sure. I kind of know what I think, but either course of action gives me a great deal of pause.
Well, I'm not going to have a great deal of sympathy for the bondholders. I'm not going to have a great deal of sympathy for the unions. It's a matter of who. I mean, I like the fact. Listen, I like the fact they're getting tough, but who do you want to be the enforcer? Do you want it to be the government, or should it be bankruptcy court judges? I mean, that's the argument.
Why don't you have sympathy for the bondholders? A lot of them are hedge funds. A lot of them are
savers. I'm not going to sympathy for them. I mean, they made a decision, and they may have to take a haircut. Obviously,
the way things usually work in probably 99.9% of cases is that if a company that has issued bonds can't pay its interest payments, they go Chapter 11 and. The creditors then become the owners, and then they get a big say in the restructuring, and they get any profits that accrue from that. Now the government is basically telling them, we don't want to do Chapter 11. You should do a debt-for-equity swap right now out of bankruptcy. And, of course, that equity you get could still be worthless, and meanwhile we will be engineering a solution to it.
Well, that's the thing. My concern is that who's doing the engineering? Is it going to be the government task force, or is it going to be probably a much harsher medicine as dealt out by the bankruptcy court judges?
So right now the path we seem to be going on is that it's
surgical. We have a surgical bankruptcy.
Right. So that by virtue of the failures of all the parties involved, the government has been forced into this position.
Well, let me ask you. Okay, what does this industry, do you think, look like in 5 years? What's your
5 years?
Yeah.
The U.S. auto industry?
We'll say what's left of the big three.
Somebody will be making Jeeps.
That's right.
Not Chrysler. Somebody will be making Jeeps. That brand will live somewhere. I don't know what else is left of. Chrysler, I guess, has sedans and other vehicles they make. Somebody might be making those under those brand names, or might not. That wouldn't be.
Do we care if they're being made in Michigan or Ohio or parts of Indiana? Do we care about that? I'll tell you,
versus being made overseas.
Well, let's say I don't know, Tennessee or something else. I did a story on was a company they made refrigerators, and it was up in Michigan, and it was very clear that this was going to be offshored or outsourced to Mexico, and they knew, and know what, it was clear for years that this was going to happen. And it finally happened. And they had all these workers there who were just stunned, had made no plans about what to do. I was at the union meetings, and they were like, "Oh, maybe I'll start up. Maybe I'll get a Subway sandwich franchise or something," which is like a complete lack of idea. But I also noticed that these people did not want to move. Right. I mean, I know they did not. They wanted to stay in Michigan. So maybe these jobs, maybe they're still here, but they're in Tennessee. Right. And so I'm not sure how concerned should I be that they're not in Michigan.
I don't think we should worry. That's not the. The location of one place versus another. I just think as businesses, so you'll have Jeep will remain from what is Chrysler, right. And GM, who knows? They still have huge redundancies in dealers and multiple brands, and
expect to see more patriotic ads from Ford because they're the non-government company. They're not government motors or Obama Motors. They're the American company that was able to survive. At least at this point, without government. What do you drive?
Jeeps.
Really? I've owned, I think, nothing but Fords. I have two Ford vans. I have a Ford minivan, and then some sort of 12-passenger big Ford Econoline because I got kind of a big family. I should run like an airport shuttle business on the side.
Well, so Ford is actually an interesting example of a lot of good reasons to be critical of companies where you have public companies where you have family control, frequently through a special set of shares that give them more voting rights. And ordinarily you would say, this is not a very good practice. Although of course the company I work for, Washington Post Company, has that model, and it works out well for us. But there are all sorts of reasons why that's a bad idea. If you get a bad heir, it basically prevents outside shareholders from coming in and holding people accountable. But, the corollary, and I did a book many years ago on the history of Corning, the big glass company.
How many books have you written?
6.
Where do you find the time to write 6 books? I can't.
A lot of them are just kind of rehashes of columns I've done. Right. But Corning had 5 or 6 generations of the same family as CEO, been public since 1945, and clear case study there of how having family control gives them the sort of freedom to do really long-term R&D. So they developed fiber optic cable, which took them 8 or 9 years to do. But you look at Ford vis-a-vis the other companies. Bill Ford, was not the greatest CEO. He brought in the guy Mullally from Boeing, but they were the only ones of the 3 thinking long-term. Right? They went back a few years ago and basically took out a giant home equity line, or basically mortgaged everything they had, and raised, I think, something like $20-something billion, and they are in a much better capital position than their competitors.
So I should continue to buy Fords, is what you're saying.
The Ford stock, I don't know, but
the
Ford cars, sure, why not?
Fantastic. All right. All right, I got nothing more. That's it. I'm spent.
I got to get back to work here.
All right, go get them. Thanks for doing it. Talk to you.
All right, see you, Jim.
Bye.